All right, today we are diving into a really fascinating accounting puzzle. It's a real head scratcher that, at first glance, looks like a mistake, but it's actually a stroke of genius. We're going to unpack the mystery of the share surrender.
So picture this. A company owes a creditor some money. Pretty standard. To settle up, they give the creditor some company shares. Okay, makes sense. But when you go look at the main financial record, the general ledger, there's no direct trail connecting that creditor to the new shares they just got. So what's going on? Did somebody cook the books? Or is it some kind of clever, hidden financial move? Let's figure it out.
To really get to the bottom of this mystery, we first have to understand the scene of the crime, so to speak. Every single company, at its very core, is balancing two fundamental kinds of obligations, two kinds of debts. And getting this part is absolutely crucial to cracking this case.
First up, we have share capital. Now, you might hear that and think it's money the company has, but in the world of accounting, it's actually treated as a debt, an obligation the company has to its own owners, the shareholders. It's the value they're on the hook for. So you can think of the shareholders as the company's internal lenders.
Then, you've got the kind of debt we're all more familiar with, liabilities. These are obligations to outsiders. Think of a classic bank loan. The bank is an external creditor, and the company has a very clear legal duty to pay them back. So we've got our two main players, the shareholders the company owes, and the outside creditors the company owes.
Now, let's say a company needs to pay back a creditor, but it's a little short on cash. Well, there's a really obvious solution, right? Just issue them some brand new shares. This is the obvious route, and we'll call it our obvious suspect. But as you're about to see, the most obvious path, well, it isn't always the smartest one. And this table shows exactly how that direct path works. On the books, it's a totally straightforward journal entry. You debit the loan account, which wipes out the debt, and you credit the equity share capital account, which creates the new shares. The trail is crystal clear. The loan from the creditor was turned directly into share capital. Case closed, right?
Well, here's the catch. This direct path comes with a lot of baggage. When you issue fresh shares like this, you have to pay stamp duty. You have to navigate a maze of legal paperwork. The whole thing can be incredibly expensive and just slow. And for a company that's already in a tight spot financially, that's the last thing you need. This is the motive for finding a better way.
And that leads us to the secret passage, a much more elegant, clever solution called the share surrender method. And I want you to think of this less like creating something new from scratch and more like using a temporary share parking lot.
See, this whole maneuver works because of a special tool called the share surrender account. What happens is the company's existing shareholders agree to help out. They surrender some of their shares. But instead of being destroyed, those shares get parked in this temporary holding account, just waiting for a new assignment.
And this is the absolute key difference you need to understand. Canceling a share is like ripping up a contract. It's gone forever. The company's obligation is instantly erased. But surrendering a share is more like putting that contract into a holding file. The share is just parked, and the obligation is held in suspense, ready to be used for something else later.
Okay, so we know the technique now. Let's follow the money. We're going to trace the accounting entries for this surrender method step by step, and you'll see exactly how this brilliant little trick is pulled off.
The whole thing happens in three really distinct stages. First, the existing shareholders give up their shares. They surrender them. Second, some of those parked shares get handed over to the creditor to pay off the loan. And third, if there are any shares left over in that parking lot, they just get canceled for good.
So here's the first entry. Let's say shareholders surrender 50 crores worth of shares. The equity share capital account gets debited, which reduces the company's active capital. But those shares aren't gone. Instead, they're credited to our special share surrender account, the parking lot. So they are officially off the main road and are just sitting there waiting.
And here it is, the twist. This is the absolute heart of the entire mystery. The key is that two things happen at the same time, but they get recorded as two completely separate events. First, look at that top entry, the share reissue. The company takes 25 crores worth of shares out of the share surrender parking lot and credits them back to the active equity share capital account. These are the shares that the creditor gets, but look very closely. The creditor's loan account is nowhere in sight. It's a purely internal movement of shares. Now, look at the second entry, the loan settlement. The company clears its 25 crore debt, so the loan account gets debited. This creates a gain for the company, right? It settled the debt without using cash. That gain is credited to a special account called the capital reduction account. And this is the genius of it. The shares move to the creditor, and the loan disappears, but the two events never touch in the main ledger. They run on parallel tracks.
So, with all the clues laid out, we can finally and definitively close the case. We can now see exactly why our creditor seems to just vanish from the ledger trail.
This slide is the smoking gun. It says it all. In the simple, fresh issue method, the trail flows directly from the loan account to the share capital account. The creditor's role is right there, plain as day. But in our clever surrender method, the trail flows from the share surrender account, that parking lot, to the share capital account. The creditor is completely invisible in this specific ledger entry. The link is broken by design.
And that's the big takeaway. The broken trail isn't a bug, it's a feature. It's the entire point of the maneuver. The ledger is telling a true story, but it's a story about an internal movement of capital, not a story about a direct deal with an outsider.
But you might be wondering, so where is the proof? I mean, the record of ownership has to exist somewhere, right? Of course it does. The actual link, the document that proves this creditor now owns these shares, is all captured in other, more detailed legal paperwork, like the company's register of members. The high-level general ledger just doesn't need to show it.
So why does any of this matter? Why go through all this trouble? Because it's an incredibly powerful tool. It saves the company real money by avoiding stamp duty. It cuts right through a ton of legal red tape. It gives the company flexibility because those park shares could be reissued for other reasons. And it even acts as a buffer. Any shares they don't end up needing just get canceled. It's efficient, it's strategic, and frankly, it's pretty smart.
And that leaves us with one final, fascinating question to think about. We think of accounting as this tool for creating a perfectly clear story. But what does it mean for financial storytelling when the most effective, most elegant solution is actually the one that intentionally hides the plot twist from the main storybook? It really shows that sometimes the full story isn't all in one place. You just have to know where to look for all the clues.